Dollar value. The value of the dollar, because of inflation, is about 23 cents since there is no backing except for the labor and collateral, which is you and me. Yes, your labor, blood, sweat, tears, energy, pays off the United States corporation's debt to the international bankers that control us all, the Federal Reserve. Another issue of concern to many is the role that foreign investors play in financing the debt. Many foreign investors are attracted to U.S. investments, including Treasury securities. On the positive side, this foreign investment helped finance the huge United States federal budget deficit of the 1980s and 1990s and kept interest rates lower than they otherwise would have been. However, servicing the dollar debt financed by foreign savings can have negative implications for our economy. When we send principal and interest payments to foreign holders of our debt, the Federal Reserve, we are temporarily transferring wealth away from the United States corporation and the states. The net result is a reduction in your standard of living. In addition, an inflow of foreign savings tends to affect the strength and value of the dollar. Since Treasury securities can be purchased only with U.S. dollars, foreign demand for these securities increases the demand and value for dollars, raising the value of the dollar in foreign exchange markets. This dollar is a debt, okay? Because as a democratic country, our society and economy is run by debt instruments. There is no actual money in the United States because there is no gold and silver backing for any of the money. This more highly valued dollar, by raising the price of U.S. goods in international terms, places further burdens on the economy, particularly for domestic producers who compete with foreign producers for sales both here and abroad. In the Fed monetizes the debt. If they monetize the debt, which they do, the result will be another burden, inflation, which is here. When the rate of money growth is greater than the economy's ability to produce additional goods and services through your labor, the result is inflation. Too much money chasing too few goods. Anytime the Federal Reserve needs extra money, they just print it with the U.S. Treasury printing presses, since they are in control of your life. In the short term, more rapid rates of money growth may reduce interest rates, but the net long-term effect would be to foster higher rather than lower rates. Another burden imposed by the debt is the government's interest payments. When the government borrows from the Federal Reserve, it is obligated to pay interest. These interest payments have become a significant percentage of total government spending, which in turn becomes harder to reduce. That's why we have such a high national deficit. Now, you can use the government's debt to pay off your debts and loans at the Department of Debt Loan Payoff online at www.debtloanpayoff.com. It is the greatest value of the dollar you will ever find. This money species has been accepted by banks, but we don't know how much longer it will be accepted. Anyway, that website again is www.debtloanpayoff.com.